Welcome to this explainer. Today, we're taking raw market data and turning it into a highly tactical, military-style briefing on three very specific healthcare trades. Right now, we're looking at a market that just delivered its first real pullback after an absolutely incredible 9-session NASDAQ win streak. What makes this so interesting is that the market was undeniably overextended. Frankly, we were all kind of waiting for the other shoe to drop, right? So this pullback is actually pretty healthy, but it absolutely requires a shift in our tactics. The tone out there remains cautiously risk-on, just with a distinctly rotational flavor. So let's dissect the exact data and build our battle plan.
So that leads us to the big question. With tech pulling back, where is the smart money actually going? With the software ETF dropping 4.3%, understanding this rotation is quite literally the key to finding actionable setups. We saw an explosive 2-day surge in software, but the fast money exited just as quickly as it arrived. But here's the absolutely critical detail. The broader market decline happened on noticeably lighter volume than the prior gains. I can't stress enough how important that is. That lighter volume preserves the overall power trend. It signals that heavy institutional distribution just isn't fully present yet. This isn't panic selling, you know. The money isn't just evaporating, it's rotating.
Now, before we get to the tickers, we need to talk about the macro environment because we're facing some serious dual headwinds. Oil has surged to about $96 a barrel, mainly driven by geopolitical risks around Iran and the Strait of Hormuz. At the exact same time, the 10-year yield has ticked up to roughly 4.49%, and that's compressing rate-sensitive names and small caps. You combine that with a looming Friday jobs report and a 50-50 coin toss on Fed rate hikes, and well, you have an environment where preserving capital has to be your absolute priority. This is exactly why our position sizing must remain strictly conservative heading into tomorrow. We need to let our existing winners breathe rather than aggressively adding brand new full-size positions.
All right, here is our exact agenda for today's explainer. 1. The sector rotation checklist. 2. The NBIX trade plan. 3. The Garden Health pullback trade. 4. The AXSM options trade plan. 5. A risk versus reward comparison. And finally 6. The opening bell checklist.
Let's jump into Section 1, Sector Rotation Checklist, Tracking the Smart Money.
Keep this checklist handy during the trading day to make sure the tech to healthcare rotation we're seeing actually continues to hold its ground. As tech and software digest their recent massive runs, healthcare and biotech have really emerged as the clear rotation beneficiaries. For example, Amgen was actually a gainer in the Dow today, totally offsetting pressures from names like IBM. Meanwhile, we're watching some pretty heavy after-hours selling in extended cybersecurity and chip momentum leaders. Think CrowdStrike and Broadcom. So our job today is to verify that capital is aggressively flowing into healthcare as a sort of safe haven while tech cools off.
Moving right along to Section 2, NBIX trade plan, Neurocrine Biosciences and its cup with handle setup.
Okay, let's open our first case study with NBAIX, a psychiatry and neurology leader. The stock closed around 165.11, which means it's still sitting right there within the 5% buy zone of its 162.39 breakout pivot. Watch for this specific bounce carefully. And remember, its relative strength rating of 70 means it's outperforming 70% of the market. Actually, let's contextualize that. It's solid, sure, but it's not at the absolute elite tier yet, so you definitely want to keep your initial sizing extremely modest. Since it's breaking out of a multi-year sideways range, there's a lot of old supply to chew through, and the risk of it just continuing to move sideways is very real. You really want to wait for an intraday pullback to that pivot on light volume before you even consider stepping in.
For our parameters, we'll be setting our hard stop exactly at 159.50 and then trailing with the 21-day EMA once it's extended to protect that capital. A close below the 162.39 pivot immediately invalidates the entry logic. And listen, if we see a volume surge on the downside, the thesis is completely broken. That is your signal for a same-day exit. But if the base resolves upward as planned, our first target is that 180 to 185 range. We're looking for a solid 10 to 12% gain there.
Now, what's genuinely fascinating about this setup is how a defined risk option spread caps both your upside and your downside perfectly cleanly. It offers a 1 to 1.4 risk-reward ratio compared to just holding the direct shares. By buying the July 18 165 call and selling the 175 call, you're laying out a really manageable debit of around 350 to 4.50. This specific structure actually pays for itself entirely if NBIX just moves about 6% from the pivot. It's a fantastic, low-stress way to capture the upside of that cup with handle while completely insulating yourself from any sudden downside macro shocks.
All right, Section 3, the Garden Health pullback trade, GH, the liquid biopsy leader.
Guardant Health is an incredibly interesting company right now. They're a massive leader in liquid biopsy cancer screening, and they have a major FDA approval catalyst currently in play. Right now, they're experiencing this beautiful, low-volume pullback that perfectly aligns with its 10-day exponential moving average. You want to let the price touch or approach that 120.74 buy point and demand to see institutional volume supporting the bounce before entering. Literally, you want to see a tight range day closing in the upper half on above average volume before you even think about pulling the trigger here.
Now, if revenue growth continues accelerating for them, this setup honestly becomes one of the absolute best risk-adjusted trades in today's data. You're risking down to a hard floor of about 117 to 118, which is just below the base structure. But if the fund sponsorship continues to build, you're looking at an initial target of 135 to 140. Finding asymmetric risk like this, taking on a very small, tightly defined risk for a large potential gain, is exactly how you survive volatile macro environments. Just keep a very close eye out for any high-volume reversal back into the base. If that happens, we exit immediately. No questions asked.
Because Guardant Health is not yet profitable, and they can be highly volatile on FDA headlines, these specific option structures are great because they allow us to compartmentalize our strategy based on whether we already own the underlying stock. If you're looking for an entry, selling a 120-strike cash-secured put expiring July 18 lets you collect premium. You're essentially getting paid to wait while targeting a re-entry right near the buy point. On the flip side, if you already hold shares, writing a 135-strike covered call funds a bit of downside protection while capping your target exactly where the chart is showing some heavy resistance.
Section 4. The AXSM Options Trade Plan. Axsome Therapeutics Moving Average Pullback.
So, Axsome Therapeutics just posted Q1 revenue up 56% year over year, which is huge. And they just flashed a textbook upside reversal right at the 21-day EMA. The initial signal was today's upside reversal. A real confirmation, though, is the next session open, but only if it holds above today's close with solid volume. And this brilliantly illustrates our core rule for tomorrow. Do not chase this if it gaps up aggressively. If it gaps up past that 3% mark, your distance to the stop loss widens significantly while your upside target remains fixed. The math simply flips against you, and it degrades the risk-to-reward ratio entirely. Patience is your absolute edge here.
If you do get that ideal entry holding above today's close, you have to ensure the setup holds those reversal lows. If this setup fails to hold today's reversal candle low, the trade is instantly negated. Adhere strictly to these invalidation levels. A close back below the 21-day EMA on volume tells us that support has failed entirely. However, if the base anchors properly, our first target is an exciting retest of the prior earnings breakout high, taking us nicely above that $200 level.
Single stock risk is super meaningful here, since AXSM won't even be profitable until 2027. That makes this 1-to-2 risk-to-reward option spread the vastly superior vehicle for a swing hold. We're looking at a July 18 bulls call spread targeting that prior high zone. By buying the 200 call and selling the 215 call, your debit is tightly contained to around $4 to $5. If AXM reclaims and holds above 200, your max profit sits around an incredible $10 to $11. It perfectly defines your risk on a fundamentally volatile biotech name.
Section 5. Risk versus Reward Comparison. The War Room Synthesis.
Okay, let's step back into the war room and objectively map out these three trades side by side so you can really evaluate the math. I highly recommend taking a screenshot of this setup. This comparative map visually proves exactly why Guardant Health offers the most asymmetric potential, while AXSM and NBIX require those tightly defined option spreads to make mathematical sense. Just look at Guardant Health's numbers. You're risking roughly $4 to $5 to potentially make $14 to $18, yielding a 1-to-3 or even 1-to-4 ratio. Meaning, for every dollar you risk, you're positioned to capture $3 to $4 in return. It's truly one of the best setups in the current data. The other two offer great technical structures for sure, but they carry specific fundamental risks, which is exactly why substituting single stock exposure for those defined bull call spreads is the smartest play.
And finally, Section 6, the opening bell checklist, execution for the first 30 minutes.
Everything we've covered today requires absolutely flawless execution. So here's your exact launch sequence for when that bell rings tomorrow. The first 30 minutes will dictate the rhythm for the whole day. Step 1, check Broadcom and CrowdStrike. Their after-hours reactions were severely negative. If they stabilize and reclaim the gap by midday, the tech pullback might be absorbed quickly. Step 2, ensure NBIX and GH are actually catching that rotated capital. And Step 3, keep your eyes glued to the Nasdaq's 10-day EMA. A clean hold there on light volume confirms this is just a standard, healthy pause in the overall power trend.
By mechanically running through these 3 steps before you deploy any capital, you confirm the macro environment perfectly matches the tactical setups we just built.
Given the massive macroeconomic risks and shifting sector currents we've just unpacked, I want to leave you with this absolutely crucial question to ensure your portfolio is defensively anchored before you make your next move. With oil surging and a pivotal jobs report ready to shake the bond market, are you absolutely certain your position sizes respect the hazards on the horizon? Think long and hard about that before you hit trade tomorrow. Thanks so much for tuning into this explainer, and stay smart out there.